US government shutdown. This is where we got it wrong because it wasn't something we could know. And there's one bit we missed that we didn't really fully grok at the time. And that was the fact that once the reverse repo had been drained, which was a net stimulus, net liquidity boost, the rebuild of the Treasury General account, they build this bank account up and down. So it doesn't really matter. But when you've got no offset to it, and the Fed is doing QT, that was a 700 billion tightening in financial conditions since July. It was dramatic.
The US government shutdown unexpectedly broke the rhythm of this crypto cycle. With the reverse repo already drained and the Treasury rebuilding its account while the Fed continued QT, nearly $700 billion in liquidity was pulled from the system. Instead of the usual post having surge, Bitcoin stalled, not because the cycle failed, but because liquidity was delayed. Raoul Pal explains this through his Everything Code of demographics, debt, and liquidity. When rates dropped to zero in 2020, 2021, companies extended their debt maturities, stretching the normal.
Stop. You don't have time. Don't miss out this 2025 bull run. Educate yourself first ahead of the crowd. We have created the ultimate step-by-step crypto cheat guide that will guide you this bull run. Unlock the secrets of crypto and make smarter investments today. Now by clicking on the link below to get your exclusive copy just under $10.
Let's start with the big picture. What are we doing here? Why does Raoul have this everything code thesis? What has he built? I try and explain to people, and I've done videos on this. This is how the world works. It's simply the structure of which the entire system functions and why it functions that way. So it's all about demographics. After World War II, I'm not going to talk for hours about this stuff. The Treaty of Versailles, after World War I, basically forced the Germans to pay reparations to the French. That caused the Germans to essentially go bankrupt and have to hyperinflate. That broke German society and caused the rising of the Nazis. That led to World War II. World War II, the end of it, led to a baby boom from world peace. Baby boom was the largest demographic boom of all time. That baby boom has basically driven the global economy ever since. The inflation of the 70s was not a monetary phenomena. It was actually driven by demographics. It was driven by the baby boom cohort coming into the workforce all at the same time, demanding goods. And there wasn't enough supply for those goods, so the world had to adapt. Then we had, obviously, the Suez Crisis and a bunch of other things that came onto it, and a bunch of money printing and other stuff that happened, but and then leaving of the gold standard, all of this stuff. But really, it's a demographics issue. As they've aged out, they've also driven everything from investment markets, index funds, pension market. Everything has been driven by this cohort. So this cohort is now retiring. It's leaving the labor force. As it leaves the labor force, we can project out into the future because of the births, deaths. What happens to the labor force participation rate? This is happening everywhere. It's falling over time. So as it falls over time, and forecastably so, we increase the debt to goose growth, because growth is driven by population growth, productivity growth, and debt growth. Debt growth is this part that I'm showing you, is to offset the slowing of the population growth and that decrease in the labour force participation rate. Less people being productive in the labour force, old people are less productive, and that leads to slower growth. So the government increases debt to offset it. That debt is financed by liquidity. This measure here is the Fed net liquidity, but actually in recent years, it's moved to US total liquidity and global liquidity for the global debt cycle. What's the difference between Fed net liquidity, global liquidity? Fed net liquidity is the Federal Reserve balance sheet plus the Treasury General account and the reverse repo that's now been drained and probably will never get rebuilt. But they've moved the liquidity onto the banks now, which is what our total liquidity measure takes into account, that plus M2 growth as well. Anyway, it doesn't really matter. Liquidity is the basis of money to pay the debt, driven by the demographics. Okay, that's the game. That's the whole game. Understand that, and you understand everything that comes after it. Then we've created this cyclicality. We had a perfect 4-year ISM cycle that changed, and it's driven, the cyclicality of the economy is driven by the debt maturity distribution. So the debts have to be rolled, and we need to, because going back to this chart, if you remember, we pay it by debasing currency. And so when the debts get rolled, currency debasement increases. And that is the process by which markets and economies have operated since. It's all the same cycle, and it happens globally. So up until 2024, we had this perfect 4-year cycle. I mean, perfect. And that was because the debt maturity of the debts after 2008 was 4 years. And then something changed. And we're like, what's going on here? We didn't really understand it until we went back to this and redid the maths and realized in 2022 and 21, when rates went back to zero, they extended the maturity of the debt from 4 years to 5 years, or 5 and a bit years. And so what that did was break this. We had this extra year in the middle that we never had before. The extra year in the middle didn't need peak refinancing. The refinancing is for this coming 12 months. So we haven't had peak refinancing. So you didn't get peak economic growth. Economic growth was held because we didn't get that stimulus. Rates remained higher because of it. And the cycle extended to this. And this is the 5.4-year sine wave. Now, we don't know what the next cycle is going to be, depending where all the debt maturity ends up. They're all sticking it in the short end right now. It might shorten it back down to 4 years. Don't know. We'll have to see. But this is what we're dealing with. And where we should end up is peak cycle is somewhere towards the end of 2026. This is the reason we don't believe in the 4-year Bitcoin cycle that's suddenly independent of the NASDAQ. They're all the same cycle. Or the ISM. It's all the same cycle. But suddenly some people online are like, well, it's all over now. We didn't get our rally in November and October. It's finished, all over. Let's come back again in 18 months' time. Probabilistically speaking, that's a load of wank. That probably gets me banned from YouTube. But wank's a great expression in England. Okay, so the game is paying the interest payments of the debt. That is where the debt growth is coming from, is the interest payments. Don't forget, the interest payments are now a larger part of the US budget deficit than the military is. And we do that by printing money. Dun, 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 dun. I mean, Christ, I've told you this a million times. So we print money and look, we've got lots of debt to roll and we need to print money to do it. Okay. And hey presto, gold has been following this like it knows. Yeah, because gold is real-time financial conditions right now. Financial conditions, the dollar, interest rates, and commodity prices. And gold is reflecting financial conditions, which is the forward look on liquidity. I'll come on to that in a sec. A bit confusing for you all, but gold is kind of explicable right now. Here's GMI global total liquidity versus gold. Gold says it should accelerate. Global total liquidity has been it got to new highs. It's flatlined a little bit because of what the US is doing. Meanwhile, China's increasing the use of its balance sheet, and the dollar's gone up a little bit. I think it probably rolls over at some point soon. We'll come on to that in a sec. And that then may lead to the final leg higher in gold and the final leg higher in markets. But you can see gold is basically pricing global liquidity impulse all the way to the end of 2026, which would be kind of what we're expecting for the cycle. Again, don't expect perfection. Raoul said, everything moves, deviates. You need to assess the probabilities, see the data as it comes in and understand. But when I put gold versus I don't know why Julian's put everything in pink. I don't know. He's feeling flamboyant. But what we've got is that's interest payments. Gold is forward pricing it. And following up is liquidity, which lags gold by 12 months. So we've actually got the phasing of all of this, these dominoes. We talk about these dominoes all the time. And why it matters to us is because it explains 90% of crypto's moves over time. Now, again, this is the issue with the impatience and the people who don't understand this stuff is like, well, liquidity's moved. Why hasn't Bitcoin moved? It's all broken. Everything's shit. It's like, no, it doesn't work like that. There is a variability around this stuff. This is a weekly plot chart going back 11 years. Not 11 years. It actually goes back, 12 years now. And you get variability around the mean. That's how markets work. That's the 10% difference in correlation. So you expect differences, and the differences give you informational value. But what you get is this stunningly high correlation over time. And again, people don't really understand this. They're like, your charts are just correlation versus causation. They're bullshit. You're just inventing stuff. I'm like, no, and no.
The U.S. government shutdown unexpectedly froze liquidity, pulling about $700 billion from the system just as crypto was expected to rally. With the Fed still tightening and no offset from reverse repo flows, Bitcoin's sideways action wasn't a failed cycle, it was a delayed one. Raoul Pal says debt maturities were extended after 2020, stretching the usual 4-year cycle and pushing the real peak toward 2026. As liquidity returns, the bull market could restart, but growing institutional control is now raising serious questions about Bitcoin's future direction.
Okay, US government shutdown. This is where we got it wrong because it wasn't something we could know. And there's one bit we missed that we didn't really fully grok at the time. And that was the fact that once the reverse repo had been drained, which was a net stimulus, net liquidity boost, the rebuild of the Treasury General account, they build this bank account up and down. So it doesn't really matter. But when you've got no offset to it, and the Fed is doing QT, that was a 700 billion tightening in financial conditions since July. It was dramatic, and there's no offset. See, in 2023, when it happened, they were draining the reverse repo, and it offset it. But this one didn't have that. And so we didn't really see that. And that was what caused that global M2 chart that like people just don't understand, because I said it's not going to work all the time. But why didn't it start? Why did it break apart? Well, it broke apart very simply because liquidity got sucked out of the system, and it got sucked out of the most beta to liquidity asset in the world is crypto. So it came out of crypto. And if you think of the crypto beta curve, you got Bitcoin and then Solana, let's say, and then let's say SUI. They're all different levels of beta or leverage to this trade. And what happened is liquidity starts coming out over this period. Now, the TGA should have been started draining two months ago. And once they drain it, it starts lifting asset prices significantly, the normal cycle. What happened this time is they shut down the government. So they couldn't drain it. So it got stuck at $1 trillion. And normally you drain it, but they didn't. So normally we would have seen something like 2022 where we start to see a drain. We didn't get that. Because it got stuck, because they stopped spending money. So therefore, no liquidity in the system. Therefore, stuff like M2 doesn't flow through the system and things fall apart. Now, NASDAQ didn't, because 80% of all asset managers had underperformed the benchmarks this year because none of them had technology, and they still don't. There's still a record number who think AI is a bubble, and therefore they're underexposed. So the more tech goes up, the more they have to buy into year end. And that dynamic's always very interesting. It's called performance or benchmark chasing. Added to the fact there's a load of buybacks in that sector as well. Very hard to fade. Very hard to fade unless liquidity is fully, totally turned and rates are going up and all that kind of stuff, which is not happening. The other thing is, if we think about the crypto market outside of Bitcoin, you'll notice that none of these things have gone to new highs, really. I mean, Ethereum, Solana, none of this has. Why? Because it's driven by liquidity. US total liquidity has not gone to new highs yet, but it will over time because, again, to keep explaining this to you guys, because you don't want to hear me, and you're losing patience, then you go, why didn't it go up? Is we've got to do this game. We've got to pay for the interest on the debt. The only way of doing it is global liquidity, or is total liquidity. And as you go through, that then lifts that. So if you go back to that chart, there's the hockey stick over time, that longer term version of the banana zone, that has to come into play, because if not, the whole system falls apart. So there you go. Now, the last time it shut down was back in 2019. Again, we kind of broke the plumbing of the financial system back then. We broke the plumbing back then. Once it reopened, so it shut down, the markets didn't like it for the same reasons. The plumbing started creaking. The Fed had to come in, start going back from QT to QE, and also injected liquidity. So here we are. The shutdown's ended. It takes a while before the money starts flowing. So the TGA's only just kind of released $40 billion, but we're expecting like $200 billion or $250 billion over the next 2 months. So what happens then is eerily similar, should stabilize coming few days, next week, today, who the hell knows, doesn't really matter. I know it feels like it does, but it doesn't. And then the market took off like a rocket ship. And all of this is to say that the reason we look at all of this stuff is Bitcoin is, and crypto is, a macro asset class. That's the important thing to understand. What it means by macro, it's driven by macroeconomics. And macroeconomics for me, is the business cycle. And here is the business cycle, up and down. We talked about that before. And lo and behold, remember that, the 4-year cycle? Well, that was the crypto cycle. No shit, Sherlock, because it was the debt refinancing cycle. And right now, the ISM is kind of in that middle year where it's not hooked up, not grown. Bitcoin's slope has been frustrating for people. I want this bit. Well, it's going to come in the next 12 months, and everyone's going to go, he said that last year. He's a moron. He's just a snake oil salesman. Look, market analysis is not some sort of crystal ball where you see the absolute truth in everything. The everything code is the truth. How it plays out is still something we need to learn. And we need to understand the nuances. When the world gives you lemons like a government shutdown, you need to deal with it. You bought the ticket, you take the ride, and you just kind of grow up and deal with changing probabilities, because that's how the world works. When we look at financial conditions, this is our financial conditions index, which is correlated to gold, as I said, even though gold's not in the index. Total liquidity lags it, so by 3 months. So it's suggesting that liquidity should start rising, which makes sense because
the recent government shutdown and stalled treasury drains temporarily froze liquidity, delaying the crypto cycle rather than ending it. Bitcoin and other risk assets have been stuck sideways, but the underlying drivers, debt, demographics, and liquidity, remain intact. According to Raoul, the real peak of this cycle is likely to occur in 2026, as the liquidity engine eventually restarts and capital flows back into the market. Beyond price action, the discussion highlights a deeper debate about Bitcoin's future. With increasing institutional control and regulatory oversight, investors must consider whether they are supporting a truly decentralized system or a more conventional, centralized financial play. Do you think Bitcoin is drifting too far from its decentralized roots? Will the next liquidity wave restore the crypto bull market, or is it a temporary reprieve? Share your thoughts in the comments.